Hello, students, and welcome to the lecture. So, students, as we know that in the previous lecture, we had started with the negotiable instrument concept of transactions, right? This is the topic we had started for the discussion. And in the previous lecture, basically, we had covered some part of this particular topic because that was the part one. In this, you can see that part 2 is written down here, which means in this lecture, we are going to talk about the part 2 of negotiable instrument and the concept of transactions. That is going to be another important discussion because we had discussed in the previous lecture that negotiable instruments are important from the competitive exams viewpoint. And in this lecture, basically what we are going to do, we are going to proceed it further. Okay. Like in this lecture, we will talk about the mutual funds, evolution of mutual funds in India, like how they evolved in India, different types of mutual fund schemes that running in India, what is the close-ended funds, what are funds classified into the equity funds, debt funds, and special funds. Then special funds are of four types that we will look. Equity linked tax saving schemes we will look. Hedge funds we will look. Five constituents that are in mutual funds we will look. NAV we will look. Okay. Checks and its types we will look. Definition of a check we will look. Parties in joint transactions that we will look. Different types of crossing we will look. Not negotiable crossing we will look. Account pay crossing we will look. Check truncation we will look. Check standardization and 2010 standards we will look. IRD we will look. Endorsement we will look. Endorsement in full we will look. Restrictive endorsement that we will also look, and at last we will look the summary. So now you can see by yourself that these all are the topics we are going to cover in this particular lecture. So by seeing this topic itself, you could conclude that how important this session is going to be. And if you have revised the previous lecture in the proper manner, then you will be less burdened in this lecture while assuming the new things. Because when your previous things are clear, then the new things could be easily understandable and could easily be acceptable. Okay. Basically, this is a disclaimer that we are required to understand before we proceed further. Okay. The disclaimer is like the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ac.in and we shall remove the images. Alright. Now, let's begin with the first thing, that is the mutual funds. Now, what are mutual funds? What do you mean by this? First, we have to understand them, the mutual funds. So technically, it is the professionally managed trust that pools the saving of many investors and invest them in securities like stocks, bonds, short-term money market instruments, and the commodities. Okay. It is the most suitable investment for the cautious investor because it offers an opportunity to invest in a diversified but professionally managed basket of securities at a relatively low cost. Because suppose if some security was for rupees 10 lakh. Now, if you invest rupees 10 lakh by yourself, that could be some risky. But Instead of investing in debt by yourself, you are just investing in the basket of a security. It means that you are just investing rupees 1 lakh and rest of 9 lakhs investing by the other 9 players. Then you have minimized your risk, but also your return will be compromised in that case. But the security you are willing to buy will be available at relatively low cost with professionally managed. So this is what the mutual funds offers. Okay, like here you can see the cycle. Investor give money to the fund manager. Fund manager invests it in the securities. Securities generates the returns that is passed back to the investors and distribute amongst the investors. And that's how the cycle runs. Investor pool their money and give it to the fund manager. Fund manager invested this money into the securities, buy the securities. Because these are securities and they are entitled to return some returns. So the securities will give the returns and these returns will be given back to the investors as they pool their money. Got it? Thereafter, how is a mutual fund set up? Now, this is what we require to understand. How these mutual funds got set up. It is set up in the form of a trust having a sponsor, trustees, and AMC, asset management company. Okay. The trust is established by a sponsor who is like a promoter of a company, and the said trust is registered with the SEBI, the Securities and Exchange Board of India. Like anything that deals in the securities and bonds and shares, all these things have to be registered with the SEBI, Securities and Exchange Board of India. So with this, the promoter of the company and the said trust registered with it as a mutual fund for authentication process. Okay. Now, if we talk about like how did the mutual funds evolve in a country? So, the mutual fund industry in India got started in 1963 with the formation of UTI, stands out for Unit Trust of India. Okay, at the initiative of the Government of India and the Reserve Bank of India. So, Unit Trust of India, that was the first milestone in mutual fund industry in India, got initiated by the Government of India and the Reserve Bank of India. Then in 1987, the entry of non-UTI, which means public sector mutual funds, got set up by the public sector banks or the PSB, like the Life Insurance Corporation of India, LIC, and the General Insurance Corporation of India, GIC. That happened in 1987. Thereafter, the SBI Mutual Fund was the first non-UTI mutual fund which established in the year of 1987. LIC established its mutual fund in June 1989, while the GIC set up its mutual fund in December 1990. So the first one was SBI in 1987, then LIC in 1989, then GIC in 1990. In 1993, the first mutual fund regulations came under which all mutual funds except the UTI, Unit Trust of India, that were to be registered and governed. The Eastwhile Kothari Pioneer now merged with the Franklin Templeton. It was the first private sector mutual fund that registered in July 1993. So we can say initially the mutual fund started by the government as the government entity of UTI, Unit Trust of India. Later on, some other non-UTI public sector mutual funds was set up, first by SBI, then LIC, then GIC. And the first private sector mutual fund registered in July 1993 by the Kothari pioneer that later got merged with the Franklin Templeton. Got it? Now, what are the different types of mutual funds schemes? Based on the maturity period. Open-ended fund. Okay, first. An open-ended fund is a fund that is available for subscription and could be redeemed on a continuous basis. Okay. It is available for subscription throughout the year and investors could buy and sell units at NAV related prices. These funds do not have a fixed maturity date. The key feature of an open-ended fund is liquidity, which means it could be liquidized anytime and the money could be withdrawn anytime. The close-ended fund. A close-ended fund is a fund that has a definite maturity date. It means prior to this could not be happened. The funds are open for the subscription for a specified period at the time of initial launch only. Okay. Now, what are the different types of mutual fund schemes that run in the country? So funds are classified into equity funds, debt funds, and then the special funds. First, if we talk about the equity funds. Equity funds invest primarily in stocks. A share of stock represents a unit of ownership in a company. And the debt funds we're talking about, these are generally of the two types. The first is the bond funds, which means they invest in fixed income securities. Example, government bonds, corporate debentures, convertible debentures, and the money market. So these are the fixed income securities, okay, from where the income will be coming normally on the general base. Gilt funds are those funds which are mainly invested in government securities. Because if you remember the financial market lecture, then basically we have come across on there. The government securities are known by various names. GSEC, gilts, or the government securities itself. Okay. So equity funds actually gives a representation of unit of ownership in a company, whereas debt funds are not giving that thing, but they are of two types. Bond funds, when fixed income securities are there. Gilt funds, when mainly invested in the government securities. Okay. Now the special funds. They are of four types. First, index funds. Every stock market has a stock index which measures the upward and downward sentiment of the stock market. Index funds are low-cost funds and influence the stock market. The investor will receive whatever the market delivers. Got it? Then, international funds. A mutual fund located in India to raise money in India for investing globally. Okay. Offshore funds. A mutual fund located in India to raise money globally for investing in India. Sector funds. They invest their entire fund in a particular industry only, like utility funds for utility industry like power, gas, and public works. It means the investment are generally made on the sector wise. Okay. So these are known as the sector funds. All right. Remember, special funds are of two types, index funds, like we have seen, These are generally for the stock market and index markets. International funds, which means the money will be raised from India and investing globally. Offshore, which means fund located in India to raise money but investing in global basis. Sector, which means that we are investing in a particular sector or the particular type of industry. Got it? Now, equity linked tax saving schemes. That is what we are required to understand. It is in short known as ELSS. Now you can see. So ELSS is one of the options for investor to save taxes under Section 80C of the Income Tax Act 1965. Got it? They also offer the perfect way to participate in the growth of the capital market and having a lock-in period of 3 years, which means that once the money invested in this, then the money could not be withdrawn easily. So that's why the fund is wealthy managed. Got it? Hedge funds. Hedge fund. There are no hedge funds in India. Okay. It is highly regulated investment fund that escapes most regulations by being a sort of private investment vehicle being offered to the selected clients. Okay. So we can say hedge funds are generally risky and as well as they are generally high returning funds. But because they are offering to selected clients, that's why it is bypassing the most regulations imposed by the country. Okay. Then 5 constituents which are in mutual funds we talk about. So there are 5 principal constituents which are first is the sponsor. A sponsor is a company established under the Companies Act and forms a mutual fund. Okay. Which means when the company is making the mutual fund. Like here we could have the example of asset management company. Now the word company is written down here, so it means it must be registered under any of the Companies Act. Like we know in this country we have the two Companies Act passed in different years. Okay, or we should like to say 3 Companies Act. Okay, first one is Companies Act 1956. Another one is Companies Act 2013. And the last one is Companies Amendment Act 2019. So now technically we have the 3 Act. 2 are in original form and 1 is amendment form. Okay. So asset management company, what do you mean by this? An entity registered under the Companies Act to manage the money which is invested in the mutual fund and to operate the schemes of the mutual fund as per the regulations. Carries the responsibility of investing and managing the investors' money. Okay. That is actually the asset management company. Trustee. Trustee is headed by the board of trustees. Okay. Or we could say a trust is headed by the board of trustees. Trustee have the duty to monitor the actions of the AMC to ensure the compliance with. Okay. Then the unit holder, another one. It is a person, entity holding an undivided share in the assets of the mutual fund scheme. So unit holder means the person who is investing the money in the mutual fund scheme and he is also holding some unit of the fund. Last, mutual fund. Mutual fund established under the Indian Trust Act to raise money through the sale of units to the public for investing in the capital market. Mutual funds has to be registered with SEBI. It stands out for Securities Exchange Board of India. Got it? Now we have the NAV. So what do we mean by the NAV? What is the meaning of this term? So NAV stands out for net asset value. NAV stands out for net asset value. Okay. It is the amount which a unit holder would receive if the mutual fund were wound up. Like you can say, suppose there was some mutual fund that was running, but after some time the mutual fund got wind up. So on this winding up time, what amount will the unit holder will receive? That is known as the NAV or net asset value. Got it? It is the total net value of all assets less liabilities, which means net value of all assets will be there and all liabilities value will be subtracted. Suppose if net of all asset value is rupees 60 and liabilities is 40, then after this 40 minus 60 remaining is 20. So 20 will be given to the holder. NAV represents the market value of total assets of the fund less total liabilities which are attributable to those assets. Now, NAV changes daily. The value of assets and liabilities changes daily. NAV is computed as a value per unit of holding. Got it? Then NAV. Common types of mutual funds and what they are typically investing. Introduction about the instruments like check and its types. If we talk about. So the Negotiable Instrument Act 1881 defines a negotiable instrument as a promissory note, bill of exchange, and the bill of exchange in the instrument in writing containing an unconditional order signed by the maker and directing a certain person to pay a certain sum of money only to or to the order of or a certain person, not to the bearer of the instrument. This is like a revision of the previous lecture. A check is a bill of exchange drawn on a specified banker and not expressed to be payable otherwise than on demand. The maker of check is called the drawer and the person directed to pay is called the drawee. The person named in the instrument to whom or to whose the order the money is by the instrument directed to be paid is called the pay. A check is a negotiable instrument which could be further negotiated by means of endorsement and is payable on demand. The demand draft is a prepaid negotiable instrument wherein the drawee bank undertakes to make payment in full when the instrument is presented by the pay for payment. The demand draft is made payable on the specified branch of a bank at a specified center. The banker's check is another payment instrument which was used by the banks to settle the payment obligations on behalf of their customer. These instruments is guaranteed by the bank for its full value and it's similar to an overdraft. Traveler's checks are a secure and convenient alternative to carrying cash. Prepaid instruments available in fixed denomination. Holder of the traveler's check is required to sign the instrument upon purchase and again in the presence of the merchant establishment at the time of making payment or realizing proceeds thereof. Now, what is the definition of a check? A check is defined in Section 6 of NI Act. Check is a bill of exchange drawn on a specified banker. Payable on demand, drawn on a specified banker. It is electronic image of a truncated check recognized under law. The Information Technology Act 2002 recognizes the digital signatures and electronic transfers as well. Then, what are the parties in check transaction? So, there are the three parties in the transaction: drawer, drawee, and pay. Drawer, who is a maker of check. Person who issues the check or hold the account with bank. Drawee, person who is directed to make the payment against the check. In case of check, it is blank. Pay, person whose name is mentioned in the check or to whom the drawee makes the payment. Thereafter, other points: endorser, the person who transfers his right to the another person. Endorsee, the person to whom the right is transferred. Now, what are the types of check? Open and bearer check, cross check, entity check, post check, stale check. First is the open bearer check. This type of check risky in nature for drawer. When the word bearer on this check is not crossed or cancelled, the check is called as a bearer check. These are payable to person specified in the instrument or any other person who possesses it, present for the payment over the counter. In case of check is lost, person who find it could collect payment from the bank. Bearer check. When the word bearer written on check is crossed or cancelled, it becomes the bearer check, payable to a specified person named in the check or any other to whom it is endorsed. Then the cross check account pay check. The person who issue or write the check specified it as account pay by simply making two parallel lines on top left or middle or right hand corner of the check. This type of check couldn't be encashed over the account. Considered as safest type of check, it could only be credited to pay's account whose name is mentioned in the check. Parties in check transactions. Anti-date check. Check bearing the date earlier than the date of presentation for payment is known for the anti-date check. Not all types of check are valid for 3 months from the date of issue or return on check. Then the post-dated check. Check bearing the date which is yet to come in future is called the post-dated check. Check is honored only on or after the date up to 3 months return on check. Then the stale check. Check turns stale after 3 months of the date return on check. A stale check couldn't be honored by the bank. Thereafter, what is crossing of a check? Crossing is an instruction given to the paying banker to pay the amount of the check only through the account credit. Check bearing such as instruction is called the cross check. Section 123 to 131 of the Negotiable Instrument Act contains the provisions relating to the crossing. As per the section 131A, these sections are also applicable in case of drafts. Then the general crossing. In this type of crossing, the check must contain the two parallel universe lines. They could be put anywhere on the check. Generally, we put it on the top left of the check. The effect of this crossing is that the check must be paid only to the banker. A special crossing. Check must contain the name of banker, may be made only once. The effect on this crossing is that the check must be paid only to the banker to whom it is crossed. Please note that the special crossing couldn't be converted into the general crossing. Not negotiable crossing. In this type of crossing, the check must contain the words not negotiable. The check must be crossed generally or specifically. The effect of this crossing is that the check nevertheless remains negotiable or transferable, and the title of the transferred shall not be better than title of transfer. Account pay crossing. This is called the restrictive crossing. The check must contain the word account pay or account pay only. Check must be crossed generally or specifically. The effect of this type of crossing is that the check does not remain negotiable anymore. Then the check truncation. Truncation is the process of stopping the flow of the physical check issued by a drawer at some point by the presenting bank and due to the paying bank branch. In its place on electronic image of the check, it's transmitted to the paying branch through the clearinghouse, along with relevant information like data on the MIC band, date of presentation, presenting bank, etc. Check truncation speeds up the process of collection of checks, resulting in better service to customers, reduces the scope of loss of instruments in transit, lowers the cost of collection of checks, and removes the reconciliation related and logistic related problems, thus benefiting the system as a whole. Thereafter, the check standardization and 2010 standards. First, standardization of check forms in the terms of size, MIC or band, quality of paper, etc. One of the key factors that enable the mechanization of check processing. Benchmark towards achieving standardization of check issued by the bank across the country have been prescribed like quality of paper, watermark, bank's logo, invisible ink, void pantograph, etc. And the standardization of field placements on check. The homogeneity and security features expected to act as a deterrent against the check frauds, while the standardization of field placement on check forms would enable straight-through processing by use of optical image character recognition technology. The benchmark prescriptions are collectively known as the CTS Check Standardization 2010 standards. All banks providing the check facility to their customers had been advised to issue only CTS 2010 standard checks. Now IRD. Under the CTS, after the capture of the image, physical check would be warehoused with the presenting bank. In the case the beneficiary or any other connected person requires the instrument, the payee bank could issue a copy of image under its authentication, which is called the image replacement document. It is legally recognized replacement of the original check for representment. Endorsement. As per section 15, endorsing means signing on the face or backside of an instrument or even on a paper called a long or stamp paper for the purpose of negotiating, transferring to the next person a negotiable instrument. Endorsement in full. If an endorser signs his name and adds a direction to pay the amount mentioned in the instrument to, or to order of a specified person, the endorsement is said to be in full. Blank endorsement can be converted into the full on later on. Restrictive endorsement, where an endorsement prohibits and restricts further negotiability of the instrument, is called the restricted endorsement. The words pay to Ashish only, or pay to Ashish for my use, or pay to Ashish for account of B are the cases of restrictive endorsement. Here we have finished the topic. Now it's part for summary discussion. So we have talked about the mutual funds definition, structure like sponsor, trustee, asset management company. History in India we have seen. Types we have seen like open-ended funds, closed-end funds. Investment categories we have seen like equity funds, debt funds, bond funds, gilt funds. Then special funds we have seen like index fund, international funds, offshore funds, sector funds. Tax benefit schemes we have seen. Then negotiable instrument definition and key instruments we have seen. Check parties we have seen like draw, drawee, pay. Types of checks we have seen bearer check, cross check, entity check, post-dated and sale check. Check crossings we have seen like general crossing, special crossing, not negotiable, account pay. Truncation we have seen. And with this we have finished this topic. So it is requested to all of you kindly revise the facts and figures that all we have discussed in this lecture and keep yourself ready for the next lecture. With this note, let's end this lecture and thank you.